Hi, everyone. Welcome to the 25th edition of FINtastic Talk. We are celebrating our silver jubilee, and we wouldn't have expected to do it so soon. But it's been a fantastic experience getting an opportunity to connect with all of you on a regular basis. And we hope that I've been able to add value to my mission of helping India create a second income. That's something which is very close to my heart. And that's my reason behind Fantastic, because I believe you should treat your investments like a business, and that one day that business has to earn you money. And if you are able to make that business big enough that it earns more than your main in business, or it is earns equivalent to that business, that's a amazing dream to have. Obviously, every large step has small steps ahead, so you have to start by understanding, learning. And for that we have made a program called Be Fantastic. Please look at it. And it is a very good program to get you started on financial planning. If you want to do something more elaborate, then recommend, whether you want to be a financial services professional or not, as a student or as a youngster, you must do certified financial planner. At least the investment planning module, it will build up amazing fundamentals of you to understand the market. So you just search up International College of Financial Planning. Now it's a global curriculum, and it'll add value to your career also. So whichever one you choose, but please build up that basic understanding and get started with your investment journey. The basic purpose of today's special edition of Fantastic Talk is to talk about the budget and what is our expectation. I know it may be already be too late for us to change anything in the budget, and whatever is coming has would already have been written. But I want to make this talk very interactive, because this is about you. This is about what the public of India wants from the budget, and this is what, as me as a leader and the other leaders who are joining us, should be focusing on. Trying to talk to the government and other leadership, that like these are the things that will add value to the investor, that will add value to the common people, and that will add value to everyone, every stakeholder. And that's things we can champion. So my request to everyone is, please, let's make it very interactive. Keep putting in your comments. And this is something I wanted to tell you, that whenever you put in a comment, we are able to see it live. So, thank you to Pradeep Mandal, Pandi, and all others who are saying hi or good morning. So please keep your comments on, keep, showing, keep on with your thoughts, so that it helps us steer. And if you have any questions, please feel free to, ask them. And it's good that all of you have taken time to be here. So without further ado, we have two amazing speakers with us today. And we are covering two different industries. Well, that is mutual fund and insurance. And we have Ashutosh Bishnoi with us from Mahindra Mutual Fund. And if you know, Mahindra Mutual Fund has done a fantastic job, despite being a late entrant, but they have made a very, very solid mutual fund with a very good performance. So thank you, Ashutosh, for joining us today.
Thank you. Thank you, Sanjiv, for having us.
No, no, it's all. And in addition to, Ashutosh, we have Mr. Satyan Jambunathan from ICICI Prudential. So, ICICI Prudential is like the go-to company of the life insurance industry. The ICICI alums are today running almost the whole industry. And you look at any company, you see an ICICI Pru alum. And ICICI always been a thought leader on life insurance. And with Satyan, we can get some very, very good insights into the management of life insurance companies. And I know I get a lot of questions on what is the security, how do the life insurance companies offer guarantees. And generally, we always take it with a different perspective of a CEO or of a salesperson, but it'll be good to understand the perspective of a CFO. So Satyan, we are very excited to have you with us. Thank you for taking out time and joining us today.
Thank you for your kind words, Sanjeevji. It's my pleasure to be with you today.
And the viewers, today we have two of the most amazing persons from the industry with us. So before we get into our topic of the budget and the expectations, so can I ask Ashutosh to tell us a little bit about your background, about your childhood, your education? Who is Ashutosh? What were his parents? What was your education? How did you get into what was how did your career move, and how did you reach the role that you are playing today?
Thank you, Sanjeev. That's a very long story, so I'll try to keep it short. Um, so I see essentially myself as a person who is a professional maverick. Um, I have now nearly a 40-year career. The first 15 or 17 of which was spent, if you believe it or not, in advertising. And I was with a very large company called J. Walter Thompson. And somewhere in that space of doing advertising and creative work, I came across a very interesting gentleman who wanted to hire me to do marketing for him and sales for him, and that was Mr. Hemendra Kothari of DSP. And it was discussions with him that led me to believe that this is the business in which I should be making a career. So back in the 90s, I shifted into DSP Merrill Lynch and haven't looked back ever since. So, but I've been on my own. I've been a corporate um, in the corporate role sometimes, on my own sometimes. In fact, briefly, I was publishing the Reader's Digest magazine as a publisher. So
Oh,
I've been in too many businesses to say that I'm a hardcore financial person, but I try to bring learnings of those businesses into this setup that we did. I I come from a place very close to Delhi. Actually, my family comes from Meerut, but my parents moved to Mumbai back in the 70s, and ever since then, I'm a Mumbaikar. Very hard to leave this place. So that's essentially who I am. Having fun doing what work I do is the central thought that I always carry. That I should be enjoying what I'm doing, otherwise it's not worth doing.
very well
So that's
said.
me.
It's all about passion and enjoying what you're doing, and it's good to see that how you moved from advertising into financial services, and into publishing, and now back into financial services. So after some time, we'll probably ask you how did you came into Mahindra Mutual Fund. That's a very challenging and tough assignment when you would have come in, but we would love
Sure.
to understand the story. So, Satyan, can I ask you the same question that, just a little bit about your childhood, about your education, and how did your career progress?
Sure, Sanjeevji. Unlike the wide exposure that Ashutoshji has had, the only thing I know in life is life insurance. I've spent my entire career in life insurance. Not just that, I'm a second generation life insurance person. My father spent his entire career in life insurance as well. What makes it closer to heart is that I'm an actuary by training. I actually came on to the finance side more by accident than by design. But my actuarial training really helps me to get a slightly wider perspective of the business and all the drivers of the business. I've now spent a little over 20 years, 21 years now with ICICI Prudential Life. I started my career with, of course, the Life Insurance Corporation, having spent 7 years with them. And that's been my journey. Uh, One of the things that I really enjoy in my work, particularly in my industry, is the purpose which the industry and the category itself offers. Today, if I were to look at the wider Indian context, it's everyone has to provide for himself or herself. And there, in that scheme of things, insurance becomes a very important, shall we say, uh, planning tool in ensuring that financial and family objectives are met. So it's a very socially oriented product category, the way I see it. I've seen enough examples of people uh, who who passed away leaving nothing to their families. And when you look at those incidents around you, it gives you greater confidence that this is the industry that is indeed your calling. And as an actuary, that's actually making it more natural for me. So I love this industry. Hopefully, I will spend the rest of my career as well in this industry.
No, no, very well said, Satyan. And I didn't know you were an actuary. Actually, we have interacted once in a while, and I never knew the actuarial side. But I do remember, I think, long time we had discussed on products.
That's
If I
correct.
remember it correctly.
That is
Yeah, but
correct.
yeah. So yeah, but that's a very different and a good side. And there are a lot of youngsters who watch these talks, and they do ask us about how to become an actuary, and is it too tough, is it all about maths and this thing. So we will take it up, this question. So Ashutosh, back to you about this, your decision to join Mahindra Finance. How did Mahindra Mutual Fund, how did it happen, and how has the journey been? You're on mute.
Sorry, it was a very, very interesting way that I came in here. I was on my own for a very long time. My previous assignment to this as a corporate corporate job was I was executive director of UTI during the time when UTI was turned around by Mr. Damodaran. I was part of his team. And having done that turnaround, I was sure there was going to be no corporate job that would give me the same level of satisfaction again. So I went on my own. But when I came to Mahindra's, which was quite a long time later, almost 10 years later, I was doing some consulting work for Mahindra Finance, and we one thing led to the other, and they said we are interested in setting up a mutual fund that will emulate the Mahindra Finance success of taking the investment product to small markets in India. That idea appealed to me a lot, and I'm a sucker for taking up challenges that nobody else will. My logic is, well, if it's not going to happen, nobody's going to blame you. But if it does, well, what do you know? It'll be a great success. So I took it on that simple challenge to say, okay, nobody else will do it. Let's give it a shot. And very honestly, all my training previously in FMCG, in advertising, came very, very handy. You know that we were the first people to start creating our product information, our product names in domestic Indian languages. My logic was very simple. To buy a soap, and I used to advertise Lux, nobody needs to know English. So why should people need to know English to buy a mutual fund? And that was a starting point of the departure in the manner in which we started to create the company. And I must say that it's been a very satisfactory journey of 5 years so far. So that's my take on where we are and how the journey with Mahindra is excellent. It's an amazing organization, which I wish I had met them, 25 years ago. I would not have left because literally the empowerment, the dignity of the individual is I have never seen before anywhere else in any corporate ever. And I worked in many multinationals as well as domestic companies. It's a remarkable place to be. It's a family that you want to stay with.
Right. So, let me tell as an observer, when you guys started, and I think we had a meeting when you had just come on the roll and you
Yeah,
had shared these ideas. They sound very far-fetched. That look, we are going to take mutual funds to B, C, D, E category cities, and a lot of people say that. Okay, look, I'm not going to be in India main. I'm going to be looking at the bottom of the pyramid, and I'm going to be looking at the aspiring India which is coming up, and that's an amazing story, that how these companies like Amazon, Flipkarts, and today people are everywhere. Like, I've invested in a logistics company, and when I look at their data, it's amazing the kind of places they are getting orders from and the quantity of those orders. So this whole story of the India as one, and the prosperity moving across is there. But Ashutosh, what is your for our viewers today? What is your current assets under advice,
sure.
and
So the total assets we manage now, yeah, sorry, please.
assets under management,
Yeah.
and how many of
So
them actually come in from the beyond those
sure. So to give you a sense in the mutual fund language, um, the total AUM that we have is approximately 10,000 crores now, and it is substantially equity. I mean, debt is about maybe 20% or less, because we've gone after individual investors across the country. Of the total assets we manage in the retail market, about a little over 30% comes from smaller markets today, as compared to the rest of the mutual fund business, where that number is more like 16 or 17%. We have now, even as a very small company with such a small base of assets, we operate from almost 70 locations of our own, 70. And from these 70 locations, our outreach is about 500 markets. Of course, there's a tremendous support that comes in from Mahindra Finance, which is a parent company, who have more than 1,300 offices all over the country. So for us, it's a simple, if you find a market is promising and there is interest in the product, we just need to place a person. So it becomes easier, and Mahindra's conviction in going into those markets is very strong. So this is where we are. Like I said, because of this, of course, the average contribution we get from customers is lower than the industry. So typically, mutual fund equity on an average, I understand in bigger markets is more like 200,000 or 250,000 rupees per person. For us, that number is closer to 1 lakh of rupees, because we are going to smaller markets. Also, the number of unique investors we have, which is we have about 370,000 total investment folios accounts now. Out of that, more than 3 lakh are actually unique, which means we are doing a lot of business with customers who haven't been in mutual funds before, which is satisfying, because that was the agenda. And I believe this will carry on. We're really small yet from a overall perspective in a 37 lakh crore business. What is 10,000 crores after all? But I think the brand is such that that it will get there. I'm very happy to tell you we did a syndicated brand research carried out by an independent agency just recently. We got in the results, and I'm still struggling to reconcile with the result, because it puts us at number 6 in spontaneous recall of brands in mutual funds. Now that's a very big, very, very big ask. And I've asked the agency to check whether they made any mistakes in calculation, but they're very sure about the numbers. So that's the opportunity as far as I'm concerned. That if people expect you to be up there, we'll just have to, you know, pull our act together and get there. So it comes off, I think, caring for smaller markets, for people delivering what they want. I know I heard Satyan say about, it's a social, family oriented product that he sells. But I've come to believe that if people want to be truly wealthy within their lifespans, there are only three ways it can be done. Number one, they have to have a tremendous skill as an entertainer, or a sports person. Or number two, they have to have a technological idea that will change the world, and we are seeing some of that from India. But we know that those two are very difficult, and you have to have attitude, aptitude, education. But the number three is just start an early start in equity mutual funds, and I'm sure you will be wealthy in a reasonable span of time, and that's the message we take to people. Unfortunately, we have a team that's delivering on that, so it's very satisfactory to do that.
Yeah, and then very well answered. Today, India, we sometimes underestimate the power of sports and the power of sports to pull out. Like, I have a farm which is quite in a rural area, and it is in Haryana, and I see so many sports complexes and the people working out and people wanting to be Olympians and people wanting to do it, and it's happening at the village level because they know that's my gateway out. The second
Yep,
gateway out is entrepreneurship. I
yep,
do a lot of talks, and I'm doing some talks for IIT Kharagpur and a couple of other IITs and IIMs and all. And it's so amazing to see that earlier it used to be, I want a good job, I want to join a multinational. Is that, now it is all about how quickly can I ready to be a part of startup. And I don't know if you guys are ordering from these startups or not. Today, anything and everything you imagine, anything and everything that used to be missing is today available. And this excites me so much about the India story that, I think we are in such an exciting place, exciting, you just think of any problem that you had. And earlier, you would say that this product is available in US, it is here. Today, you think of anything, and these startups are making that possible. And the third way is very important is that yes, if you can't do it yourself, then ride the wave. And the best way to ride the wave is just to do a mutual fund SIP or insurance ULIP and be a part of the market. It's I'm very excited about India's growth prospects, and I think it's an amazing opportunity to be a part of this journey. So my next question is, Satyan, I want to ask a question, and since we have an actuary with us, so it'll be very interesting to get your answer. So life insurance industry has also reinvented itself. At one time, life insurance was a hard sell product, and it used to be hard sold. And then there was a era of mis-selling and telecalling. And but by 2014-15, life insurance industry has reinvented itself. And after that, these guaranteed return products have come up, and also the legacy planning, the term insurance, which is giving coverage till the age of 99, which is virtually like a legacy planning. It's like a whole life, and it's a very low cost term insurance. I'm amazed at the rates, and I'm a personal buyer. I personally bought it for myself, and I talk to so many customers who say, "Okay, look, I had this vision that I wanted to give business to my son, but I wanted to give an equivalent amount to my daughter. So I bought it. I want to buy a 20 crore 99-year plan, because that becomes my legacy planning from my daughter, and I'll keep paying the premium out of my business." So some very innovation has happened. And today I see some of the most sophisticated investors, especially from the financial markets, putting huge amounts of their own money in these guaranteed return plans, which are offering 6.2, 6.1% tax free guarantee for the next 20-25 years. So how did these plans come about? How are they sustained? And what is the how is this innovation happening? And has it what has been the impact on the numbers and the kind of business that you guys are doing?
So maybe I'll start with saying this that as an industry, we are a highly regulated industry. And one of the key orientations of the IRDAI, the insurance regulator, is to ensure that all the companies in the industry are financially sound. So anything that we do from a product construct is after approval from the regulator, and it is after convincing the regulator that these are products which are financially viable and sustainable over a period of time. The second key message that I would start off with is to say that any financial product that you buy, particularly in the insurance space as well, adds most value to you as a customer if you stay to the end of the term. You have to make sure you do not discontinue early. If you have doubts, take a lower premium, but make sure that you continue the policy to its maturity. So the guarantee that Sanjeev you spoke about really applies only if a person stays to maturity. So the big message I would want to give to everybody who buys an insurance product is you must stay to maturity. Do not allow your policy to discontinue. The third, whether it is a guaranteed return product on the savings side or a term insurance, the insurance cover is a very important part of it. Sometimes we tend to ignore it. The way I would describe it is to say that the role that an insurance savings product plays is, if I'm alive, I reach my savings objective by contributing to it. But if I die, the insurance cover ensures that the savings objective still is met for my family for what I contracted. So value the insurance cover and don't just look at it as a return oriented product is the message that I would want to leave. Particularly, how do we manage these product lines? One very clearly on the guaranteed return product is the financial markets are now evolving. There are a number of long-term government bonds available. There are also lots of products such as forward rate agreements or derivative instruments which are offered by banks. What we try to do when we promise a return to a customer is to lock into that return for the rest of the term. And that's how we are able to provide that return. So we use a combination of underlying financial products to be able to deliver that. On the term insurance side that you spoke about, the whole of life, Sanjeev ji, the entire term life products can be used for two different purposes. One, for a person who's just starting to build his wealth and he doesn't have enough wealth, it is a way of protecting the family against an adverse financial impact. For that kind of a customer, my recommendation would be that your term life cover should stop when you reach your retirement age. After that, what you need more is health insurance. The other purpose that a term life can be used is exactly like you described it, Sanjeev ji, which is leaving behind a legacy to family. And this is something that you may want to think about doing when you're much more affluent, when you have a greater wealth, and you want to find a way to pass the wealth along. But at a base level, if it is a term insurance that you are considering, the first step I would suggest would be to take it for the period up to your working age, which is till retirement, and ensure that you have a health insurance cover to cover potential cost of healthcare beyond the retirement age.
But Satyan, going forward with that question, now this is a huge debate that there are a lot of people who believe that you should buy a term insurance till the age of 60, 65. And but I'm actually I'm a believer that look, you have limited money, pay 20% extra or 30% extra and take it till 99. Because at the end of the day, in today's world, we are never going to stop working. We are never going to be stop being active. The longevity is increasing. Who says that a person will retire? Everybody, if you talk to every retiree, he's doing something new. He's found a new passion, and the liability and people depending on you are always there. So even when you're older, your children are doing quite well, but everybody wants to be have that think, okay, I've done this for my children. And especially in India, like people want to give an X amount to their children, and even if they're very well off, they will not spend money. They will, "Okay, look, this is for my children after me." And because they want, after the children, it becomes for the grandchildren, that I'm doing it for my grandchildren or my great grandchildren. I want to do this. So they don't truly get to enjoy their money. In fact, I have done for a lot of my own customers that I've told them, look, buy a 99-year legacy plan. Your money is your money. The remaining part of money, just go splurge, go on a holiday, enjoy yourself, live your life, do what you want. So point is that I do understand that as a manufacturer, I would want a person to take till 65. But shouldn't a person take a term insurance for the longest possible term? And as an industry, don't we want? Shouldn't we be doing some education around that? Because I feel heartbroken when people are buying these digital policies which are getting advertised through the digital platforms, and I look at a product, it's a 5-year term or a 10-year term. I feel, how can even regulator, you say, we care for the customer. How can you even allow those products to be sold to these people? Those products are meant if you're taking a loan or you're working on a project, there is a liability. And or tomorrow Ashutosh has been appointed as the CEO and Mahindra is investing a lot of money and they want, okay, look, we must have a cover on Ashutosh for the next 10 years till he builds an amazing company for us. But how what is, what is the right thing? What is your view on this? I know it's a very open debatable question, but this is where I have a total contra view.
No, absolutely. And I don't think there is a single right answer to this, Sanjeev. And it is not really about a manufacturer view or anything. I'm looking at it from a customer point of view that there are two sets of customers. When a person is starting off and doesn't want to spend more on insurance cover, that is a period of time where to cover up to working age may be 60, 65, 70, 75, it doesn't matter. I'm not putting a number to it, but up to working age is efficient. As you get wealthier and as you are willing to then leave that legacy behind, then you start transitioning into the whole of life that you described. So you very well, from a life stage point of view, as a customer starting off, may start with something which is providing you cover till the earning years. And then as you advance in age, then you start buying something which can leave behind a legacy. There is a place for both. There is a time for both in my mind. I agree with what you're saying. Shorter term products have to be for the purpose of covering liabilities. Otherwise, longer term product is more desirable. It is just that when I have X rupees to spend, where do I want to spend it? And 8 out of 10 people really have to make that decision. So in a life stage, my recommendation would be start with a term to working lifespan. And as you progress in life and you are able to afford more, then you start moving into leaving a legacy behind.
Very well answered. So now let's get into a little bit of budget expectations. So Shashank Shekhar Pandey has posted a question, and which is something that is a very interesting topic that keeps getting discussed. I don't think we'll find a solution to it, but it says that isn't it time India goes for expenditure based tax and not income based tax? So, Ashutosh, would you like to give your views on this?
Yeah, okay. See, there's a little bit of history of India taxation, which I think we need to understand before. Of course, I think everybody should ask for lower taxes and everybody should get lower taxes. But is that feasible in an economy like ours, where we have the need to build infrastructure to the scale where I think we have hardly even begun? Of course, a lot of good work has happened on many things, but I think we all agree that there's a long way to go, which will lift the life standard, the manufacturing capability of India. In that sort of a scenario, I want to share a little bit of history here. You know, before independence, we were a 100% or nearly 100% tax paying nation. In fact, the entire system of the government was created. It was called the revenue service. It's still called revenue service for some reason. But the collectors and the district collectors and all those were terms that came out of people who collected land-based revenue. Almost everybody paid it. The tax base was huge, and the government had the capability to spend. Whatever they did, it was another government. Is We can discuss that separately. But after we became independent, the land tax was abolished, but nothing of substance actually replaced it. And as a result, government collected small quantums of money and tried to spread it thinly over a period of vast number of people. And the only way to do it was, to try to helicopter small bits of money to a lot of people. That, of course, has its own challenge of over 70 years having done that. You basically create a very high inflation economy. But the new governments of recent times have tried to change that whole perspective by creating an alternative taxation regime, which we have seen in GST. What else is this? This is an expenditure based tax. Everybody pays it. And we know we went through, and we're still going through to some small extent now, a lot of angst that happened to small businesses whose only margin was the tax that they saved by not paying it, right? I think as we become a tax compliance nation and as we increase the tax base, it can come from income tax, it can come from expenditure tax. Yes, I think it can come from both. And if it comes from expenditure tax, chances are tax compliance is much higher because everybody pays. One of the things you have to remember as you get more tax compliant is your capacity to ask the government of what they did with your money radically rises. And tax accountability becomes everybody's concern. When 3% of the people in the country are going to pay income tax, after all, how many questions can 3% ask about what you did with my money? But if 99% of the people are going to pay a tax, well, they're all going to ask, well, what did you do with my money? And I think the governments are alive to that. They are doing a lot of work with that money. We are seeing all around ourselves, and I think I can speak for everybody in the country when I say somewhere close to you, a new highway or road has happened or expressway is happening. That's changing the way lives are being lived in that space. And it's not just the roads, it's power, right? So clearly, as an individual, would I like to pay lower income tax? Oh yeah, I love it. But as an economist, as somebody who's working in the industry, as somebody who would like to invest in industries, which is what I do, I would like to see industrial expansion grow rapidly. And the only way a government can make that happen is by collecting more taxes. And I think we are reaching a point where collection of taxes via the expenditure tax is going to be much more than income tax. So will I weigh saying that expenditure tax is better? I would say there is room for both, because after all, there is income tax to be paid by people, substantially more by people who earn a huge amount more than an average Indian. There is, I think, tax fairness in that. So I think there is room for both. I would not weigh one for the other, but I think expenditure tax is a great initiative, and I think it's going to make us more tax compliant and more accountable to the people.
I think that's probably one of the most best answers, Ashutosh, anybody could have given to this question, and it is so elaborate. But Satyan, can I have your views on this also? What do you feel about this?
I would agree with what Ashutosh said, that eventually it will be a combination of income-based and expenditure-based tax. Which way the balance tilts is also a function of what is the disparity of incomes amongst the population of the country. If it is a much more evenly distributed income, you may very well see a situation where expenditure tax dominates. But if you have a much more uneven income distribution, then you may very well see income taxation being a substantial part. So I would say we should let this float along with growing affluence, along with growing wealth, along with growing earnings of India. It will find its own balance, but I would expect there to be a combination of both.
Yeah. No, I fully agree with that. Now, point is that the whole concept is that you want to increase the tax compliance, and I really liked Ashutosh's view of and I didn't know that this part about the history where the whole at one time everybody in during the British Raj used to pay tax, and now if you put two plus two together, yes, that was truly true, and there was a almost that was a land based tax, but now we have an expenditure based tax. But I think expenditure based tax is more and it's also a very good way to look at it. Since I'm paying the tax, I should hold the government responsible for what they have done. And today, GST is almost being paid by, let me say, almost 99% of Indians. So they need to hold the government accountable from where the money is going in. But let me also ask you, but where I find it slightly confusing is that whereas throughout the world there has been instances that when the tax rate is reduced, the tax compliance goes up and the overall collection goes up. And we have seen it in corporate tax. Corporate tax rates have been brought down to 20-25%, and various schemes they've been simplified. Whereas the individual tax, especially for the high net worth, has been consistently being increased. The last couple of budgets, we have seen the individual tax, at least on the super HNIs, and that's not a big money. That is affecting. I don't think that will make a huge difference, but it definitely dampens the consumption of the industry because these are the people who are going out there and spending the money. So, do you think it is? So, what can the government do to increase the consumption? Because see, when we talk about Make in India, we talk about anything about India. It's all about consumption. It's all about people buying. It's all about people spending more. So there's a dichotomy there that, and I am a firm believer that this personal income tax has to be, it has to be made more uniform. More will have to be brought under it, but the rates have to be reduced so that people are going out, buying, spending this money. They are encouraging the economy, and once that expenditure is happening, you are anyway collecting tax on through GST. So there's a different way of collecting that tax. So, Satyan, starting with you, what is your view on this pushing spending in the country? Because this whole Make in India, the whole India growth story is going to come from there.
So, Sanjeev, the entire idea of what will stimulate spending can actually happen through multiple mechanisms. One way is for the government to give money to everybody, distribute money and say spend. That is effectively the subsidy or a direct cash transfer kind of way of saying that I'm putting money in your pocket, go and spend it. The second way of doing it is to, like you described, increase disposable income by reducing taxes so that there is then an ability for people to spend more. But it's not just about stimulating consumption. It is also about, from the supply side, ensuring that what is required to deal with the consumption needs are met. And that is where norms around being self-sufficient in manufacturing, ensuring that services are originating domestically as opposed to being imported, and therefore we are creating the capacity to supply, is equally important to create capacity to consume. Beyond consumption, I think there is also a very important aspect of countries' growth, which is driven by capital expenditure or infrastructure spending. And this is something which typically can only be done by the government. Now, for the government to be able to do this, they clearly have to broad base their revenue the way Ashutosh described early on. And the more people, therefore, that they can get to pay taxes, they are creating a larger pool of money from which they can put money into infrastructure building and capacity building to stimulate consumption. So while at a personal level, I sympathize with what you said, that ideally I would like to pay less tax as an individual from an income tax point of view. But realistically, given the state of evolution of the country today, there will be this mix. And from a government consumption stimulation point of view, it will be a combination of putting money into the wallets of people, giving people a bit more disposable income, and along with it, creating the capacity for manufacturing and infrastructure so that the supply side of the consumption need is also fully met.
Fantastic answer, Satyan. So, Ashutosh, what's your view on this? What's the
So thanks. So I totally agree with Satyan on the part that supply side needs to have a cleaner supply channel to improve. For example, today what we face is what we call supply side inflation, right? And that dampens consumption. So supply chains being clearer is a function of what kind of investment in infrastructure you were able to make and how close you were able to get to the customer and how cheaply. In my view, as an economy where we are, yes, consumption will be there, and I don't think you need to tell Indians to consume more because let's face it, outside of the top 2 or 3% of the population, you supply and people will consume because they're still at an early stage of what they're consuming. They're not into what you call discretionary goods yet. And what's the penetration ultimately even of automobiles or even two-wheelers? It's not that much. So if they have the money, they will consume. If they have the income, they will consume. But I think at the stage we are in the economy, the most important thing for us today is to create capital. You think about it. As a nation, we are constantly talking about, oh, we have to build this infrastructure, we need capital, we need multilaterals to come in, we need global capital investors, oh, we have something else to build, we have automobile business to build, steel factories to build, and we need capital. Somebody will from outside will come. We literally go around the world in a sort of a begging bowl asking for capital. Why don't we have capital? What happened to the capital that we had, or how can we create this? I'll give you a very simple metric. You know, at 1945, we were all in the same place. All the countries in the world except the United States were exactly in the same place. No capital, nothing. Everything was down after the war, just rubble. How did they create capital and we did not? The simple fact is, capital comes when household level consumption is curbed and investment is encouraged. When you say to people that look, Yes, you can consume what you need to, but don't go overboard. Save that money, put it into capital markets. In all these 70 years, the difference is in India, household investment in capital markets is less than what 5% of savings or 3% of savings, right? In the United States, it's 50%, and 70% of United States households participate in capital markets. They are bringing their savings, giving capital to entrepreneurs, and creating capital. Not that we don't have it. In India, what have we done? We've taken the money and bought more pieces of land. We've taken that money and bought lots of gold and put it into your lockers. And nobody sees the light of day. Land is a dead asset, gold is a dead asset. That is where we need incentive from the government for households to bring that capital out and let it into the markets so that India has capital. Our GDP to capital markets ratio is the lowest in the world, right? In other countries, if you take, for example, I'll speak of the mutual fund business, the fund business. Just the fund business in the United States is almost 180% of GDP. Where are we? We are at 11% or something like that, or 10%. I think that's where I would look at policymakers to make a change. How do we encourage households to participate more, bring their capital to give it to entrepreneurs for risk taking, so that we can stop going around the world with a begging bowl? Just the value, for example, of gold. Sanjeev, I don't know if you know this. Indian households and Indian temple trusts together hold 5 times more gold than the rest of the world. It's just lying there, right? And India government doesn't have that gold. It has got a small reserve, and it just earns nothing. And more it is difficult to bring it out also into public domain for people for safety reasons. So clearly, there's an opportunity that we need the policymakers to shift their focus. If we have to build infrastructure, we can't just keep depending on taxation. We must have private capital come in. It has to be brought out of the household. I can tell you in 1964, because I was part of UTI, it was created for that purpose. The definition of the purpose was to channelize household savings into capital markets. And like 50 years later, 60 years later, I think we are just incrementally moving in that direction, not yet there. It will take a significant policy shift, a direction set by the policymakers, and I think that would change everything. You have more capital, you will create more income and more consumption. I think that's the issue to address that I'm looking forward the policymakers will do, and I'm sure they are alive to this.
Yeah, in fact, so let me say that, it's amazing we are doing this talk on this topic, because I'm seeing you, Ashutosh, in a totally new light, new version, new thought. And same is with Satyan. If this was a normal, this thing, we would have just been sharing normal views. But this is amazing. And the kind of facts and figures, Ashutosh, you're coming out with are absolutely phenomenal. And I think you made a very, very strong case for personal capital. But let me also ask a contra question. And this is something, I find it heartbreaking that, look, even if I'm saving in mutual funds, I'm saving in banks, I'm saving in other instruments, this capital is only being given to very few, because the pressure we have of security, the ratings, and there is no mechanism for protecting, loans and other things beyond a level. Despite being such a mature market, financial underwriting of, loans or insurance of loans and insurer credit risk policies are not available in India. So shouldn't something be done about that? So because we have to make capital democratic, whether we like it or not, capital is going to maybe 5,000 people, 10,000 people in the country. That's not going to build the Indian economy. Whereas when we talk about US and we talk about other economies, there anybody and everybody can borrow. Here, even if I've run a small company and startup, they're doing well, for them to take a loan is such a big challenge till I don't get involved. And they will not get it because people don't know that, okay, it's backed by somebody who has some credibility. And I feel sad that this situation has to be where I have to get involved, and the loan is coming on my credibility, not the credibility of the business. So how does the government solve this? how do we democratize capital? So let me ask you first, Satyan, that what is your view on that? That how do we make capital more available democratically rather than selectively?
It's a very interesting thought that you stimulate, Sanjeev ji. And it is indeed true that people with more established track records have easier access to capital. Um, and therefore, people without an adequate track record of delivery struggle to get capital. Uh, but I don't know whether the answer to that conundrum is, however, very easy. Because if I were to flip the problem, the biggest risk of unbridled democratization of capital is moral hazard. Eventually, there has to be an incentive for the business or the entity or for the venture or for the purpose for which capital is created to be to make a reasonable attempt at success. And that is really the conundrum. Now, everybody is trying to eliminate moral hazard through very, very stringent underwriting. And that, in a way, makes it more difficult to provide that capital. There are ways in which it can be aided. One, of course, like you described, is insurance products, which can be that layer of protection for investors so that they can take it. But in the way our current, shall we say, economy is structured today, where micro, small, medium enterprises are so many and without a significant track record and with a very important contribution to make to the economy, it may very well become necessary for the government to play a more active role in being regulator to some of this subject to some conditions. Whether private capital can be the only source which will help this democratization, I don't know yet. But I do think that both private sector and the government sector will have to come together to find a solution to this because even in the way I heard Ashutosh describe the desire or the need for the country to create more capital, it's not just about capital created through large projects. It's also capital to be created through a large number of small projects. And for that purpose, the democratization that you described is indeed very essential. It's just that I don't know if we have the answers to all of the challenges to that right away, but I suspect it may need to be a combination between private and government.
No, I think it's a very interesting discussion that we are doing. So if you look at the capital which is available, it's through the microfinance companies, it's through the NBFCs who are going and lending. And this whole boom has happened. I one of the bankers, one of very senior bankers was sharing with me. I don't know whether that number is correct, and I'm sure Ashutosh is always on top of his numbers and he'll have that numbers. He was sharing the NPAs of MSME and small companies is not even 2% of the NPAs of the large companies. I don't know whether this is true. I'm sorry, I'm quoting it on a public forum, but if that is true, we are giving such humongous amount, and I meet people that who have got such humongous amount of loans, and I don't understand why would you give them such high amount of loans, and whereas if you give those 50 crore, 50 lakhs, 1 crore, 2 crores, 5 crore loans, there can be so many people setting up industries, so many people setting up businesses. Yes, there's an element of risk there, but those people, I think, are more conscious. So Ashutosh, our numbers champion. So do you have a number of that? That how much percentage of NPAs are contributed by the large or this thing, and what is overall? But overall, what is your view on that?
So a couple of things. Of course, so immediately what you asked about the NPAs, of course, MSME NPAs will always be small. You have to remember that as a percentage or as a percentage borrowing of the total borrowing that is done in the country in a year, MSMEs are not that large in terms of the volume of money they take. So therefore, as a percentage of NPA, though actually the percentage of NPAs that MSMEs have today, if I'm not wrong, is somewhere between 12 to 13% of the total borrowings they have made. But as a total sum of money, that's not a very large sum of money as compared to the big borrowers, which is the large industries, or even in the personal credit or agricultural credit space. So it may look like they don't really matter so much. It's a small amount of money that you may lose, but why don't give them more? I think I want to flip this question around a little bit differently. The question is about availability of capital and not necessarily only about debt. And I think the movement that I'm seeing and from where I'm coming from, I think we have a fantastic opportunity in this country where a lot of people are eyeing and have already participating is in setting up private capital going to small businesses. Yes, it started at the end, the technology end of the business, right? That's where it has started. But more and more, I find people who are willing to give capital to startups and to entrepreneurs and to small enterprises which are not technology led. So there is at least five different VC firms I know of substantial size in India who give money only to consumer facing businesses. They are saying we don't want tech because that's overdone. I think there is need to encourage that movement. And we need to create a counterbalance. Of course, there is no substitute for debt. But if you think about it, in the absence of equity, as a country, we have depended on debt. Look at other countries of the world, debt is a much smaller portion of the funding. It is essentially equity that funds. Now, can we imagine a framework of confidence to be backed up by a legal system, by the government mechanisms, where this equity capital is also has a sense of protection that it is not going to be abused. If I'm giving it to an MSME or I'm going to a small entrepreneur startup, there is a system of framework which is not just rating agencies, etc., where I can go to and if there is a problem, I can resolve. That's what the equity giver should know. For example, there is I don't know if you know this, but the exchange which is the SME exchange, right? That has now come
Yeah.
up. The number of listings I'm watching on that is rapidly rising, and they're all hoping that in 3, 4, 5 years time they will be on the main board, right? The idea came from the UK based AIMS. Right? AIMS is a subsidiary exchange to LSE, and all the startups and the early stage businesses they list there in search of equity capital. I know merchant bankers in Bombay now whose only business is to take companies to the SME exchange. And literally now there are hundreds of these. So I think it's an evolutionary process. We need to gravitate from being totally dependent on borrowings to moving towards equity. We have to realize that there is a lot of equity capital that is now available for small companies and startups, but doesn't know how to find those people. It's a simple fact. I meet a lot of entrepreneurs who've done well for themselves, startups, they've sold businesses and they want to fund startups. And they go searching and looking. Now, if there is an exchange mechanism of this type, which then allows a certain degree of a sort of a structure within which that can happen, I think those are the opportunities we have to look for. And I think additionally, I would say within the financial investing systems or the community or the domain, I think we need a quick resolution mechanisms. We shouldn't have to go to a civil court and file for fraud and file for recovery of dues, and that's a very very cumbersome process, and that puts people, make them step back. I think we are capable enough now as an industry to set up those mechanisms, and I would imagine starting with the ARCs, and I will see where the bad bank goes. But if we can set up those kind of systems for ourselves, we just need a government's legal backing for it. We should be able to resolve it fast. So I think I see us moving in that direction, and I don't think that direction will take a very long time to happen. The dependence on borrowed capital needs to come down, and as we get more household capital into the domain into equity space, you will see more and more VCs and more private equity get into funding of smaller businesses. That's my take on this.
Yeah, in fact, again, amazing answer, Ashutosh. Uh, and this puts a thought. I am a very, very avid private market investor myself, and I take it as a part of my CSR. So at least one day a week, I dedicate to helping mentor startups. And a lot of people I mentor, they get amazed. Okay, look, sir, we are surprised at the amount of time you're spending to us or the value. And I've created a team to help them with design thinking, a lot of other stuff. And the point is that, but it is my give back to the society. It makes me feel so proud that I've invested in companies, I have helped build up some good companies, I have helped solve some issues which were not getting solved. So Ashutosh, your point is of private capital, and this is where one of the guys had written a very amazing note, and which I should actually make it my budget expectation. And even what you have said is that in future budgets, that at least there needs to be, like, you have a CSR budget, that you need to put 2% of your money into CSR. There needs to be some tax saving given for corporates and individuals start investing into startups. So so yes, I am taking the risk. If I say that, look, if you, for a corporate, it can 10% or 15% of its profits, if it says that I will do startup investing, the government will save only, government will, it costs government 5 rupees, but 15 rupees will flow into the private companies and growing this entrepreneurship culture. And that can be an amazing, where I am taking majority of the risk. So I think that's a great budget expectation that has come out of what you have said, what Satyan has said, and I think
Yeah,
that will be amazing for the Indian
absolutely.
economy. So
I
now
think it's a
going,
great idea.
yeah, in fact, we should take it. And there's a question that people are asking, that we have such amazing people from the industry, but what is the expectation of the insurance industry and the mutual fund industry from the government? What do they expect? What are the things they're expecting in this budget, and what are the long term expectations for the industry from the government, that where do they need relaxations, or what are the changes are they looking for? So starting with you, Satyan, what is the insurance industry expectations from this budget, and the long term, like maybe future budgets? What can the government do to boost this industry?
So Sanjeevji, if you look at the services and the products that we offer, you can broadly put them into two categories. One is savings oriented solutions, and the other is pure protection oriented solutions. Now, if you look at a situation where a protection oriented product that is being sold for protecting the financial well being of a family enjoys or is subjected to one of the highest levels of GST, that seems a little counterintuitive. So, one of the thoughts that the industry has been representing to the policymakers is one should treat insurance, or at least the pure protection side of the insurance, as more of an essential good, and therefore apply rates of GST which are consistent with essential goods as opposed to the higher end of the GST spectrum. The second part of it, with respect to the long term savings that we end up mobilizing, uh, one of the big challenges there is in the context of annuities. And annuities is something which helps an individual protect against the risk of living too long. Unfortunately, the money that a person puts into annuities today is from post tax income. And the annuity itself is a combination of principal and earning on it. And the whole annuity amount is taxable as income. Effectively, an annuity becomes a double taxed product. But again, from a need of protecting a family against longevity risk, it is a critical component of what needs to be in a family's bouquet. So this is the second area where the industry has been very closely engaging with the policymakers on giving or taking away this double taxation regime that exists today effectively for the annuity products. So these are the two big things that we have expectations from policymakers on, that either now or over a short period of time, if they are able to provide support to the industry, it's not just about the industry, it is also the wider consumer at large, and that should help extend the coverage of insurance in the more mass oriented market.
Fantastic answer, Satyan. I think these are fantastic expectations, and they'll be phenomenal for the investors. My personal view is that, look, life insurance industry is always criticized for giving low returns and being expensive and not being a great investment. and at the same time you're charging GST on even investing. Okay, which is absolutely crazy. I don't understand. Like, yes, on term insurances and health insurances, let them being taken as, but they are still consumables. And, whether they are essential, they should be taxed at 18%, 12%, or 5% is one thing. But why would I pay GST on an investment? And then when I have to pay GST on an investment, I will get criticism because 2.36% of the my investment has gone into tax. So if my 2 point, that government doesn't even allow that much commission to be paid. That is the kind of money they're taking away in tax, which is absolutely crazy. And then the industry gets the blame for not being able to deliver the returns. So, Ashutosh, now up to you. What is the mutual fund industry expectation from the budget, and what can this budget and the future budgets deliver for the mutual fund industry that will help it grow?
So, Sanjeev ji, the thing is, mutual fund industry is doing a lot of work, and it's very close to my heart. I'm part of the team that pushes that agenda along to take mutual funds into smaller markets. And the entire financial literacy campaign that we carry out, I actually work very closely with the team to make it happen. And I think most of the support that we will look for from the government in this budget and later policies is to enable, to create enablers to make that happen more and faster. So, for example, for a while we have been requesting the government to consider. So, we have this thing, the ELSS tax saving scheme, right, which comes under Section 80C. Now, that's an equity scheme, and we believe that in the Indian context, there are a lot of investors who would rather take a debt risk, and perhaps a debt-based um, a tax saving scheme is probably quite naturally should follow. Those are simple things, but on the whole, as an individual, and I speak for the industry as well, what I would say, if you continue the thought that we should get household savings to come into capital markets via mutual funds, what stops it is the penetration, because distribution strength sort of runs out after the first 400-500 cities. With the kind of earning possibilities that distributors have today, it is difficult to imagine that they will be able to go to the 1,000th city. The margins are really slim. And I think somewhere in the evolutionary process, perhaps it's been a bit early to have cut down those margins so fast. I remember when I joined Merrill Lynch in back in the 90s, the distributors used to decide with the investor how much they would charge for their service. It wasn't the job of the asset management companies to deduct something and pay the distributors. But even then, the commissions that they could charge would range in the region of 2 to 3%. As the market grew more efficient, those commissions came down, and today I would think they are somewhere in the region of less than 1% in the United States. In India, and that's when that industry has grown from probably in 1990s it was less than $1 trillion all told. Today the US industry is 23 or $24 trillion. We haven't grown by that much. But I think as we evolve and as the business grows, then looking at reducing distributor commission is worthwhile. Perhaps it's been a bit early and it's perhaps stopping the penetration at some level. So enabling penetration via the distributor, I know I'm going out on a limb by making the pitch, but self-initiated investments are almost unheard of anywhere in the world. People require somebody to hold their hand, and if there's somebody who's holding their hand to show them the right way of investing, it's not going to be remunerative for him. He's not going to do it. So I think somewhere in the regulatory and the policy system that needs to be recognized that we need more people to go out there and bring in investors into the capital markets and their savings into the capital markets, and it should be remunerative for them. I think that's the space which would be the most contentious. It's difficult to suggest that cost should be increased for the investor. It seems politically wrong. But I think unless we address that issue of creating the right incentive for the intermediary, we are going to constantly suffer from an over concentration of mutual fund contributions coming from top 10 or 20 markets. And beyond that, it will be very difficult to keep getting customers in. So I would look for a longer term solution on that. And it's not just about costs. There can be many things done. There can be spreading awareness on why this is important to do, for example. So there are many things which need to get done there, and I would look for dispensation there. Besides, simple things like the debt related tax saving scheme.
I think again a fantastic answer. And mutual fund industry does have that issue of large mutual funds being at a unfair advantage over the smaller ones. In fact, I was doing a talk to IFA, one of the IFA communities, and they were always very keen. But I think that has also worked very differently also. That if you look at all the smaller mutual funds, they get so much support from IFAs and distributors because they just want to prove a point. Okay, look, there is a feeling. I don't know whether that's true or not, and maybe it doesn't get affected at our level, but in the IFA community, that look, the larger mutual funds have not been fair to us. They have taken away our earnings, so we have to support the new ones. We have to support the smaller ones, and we have to do it. And it was such a amazing experience for me to see that, and I hope that's working on the right spirit for you also, where people are very open. One last question I need to take, because this is an investment topic. I know we are over time, but this is something I just can't do away with. So, Satyan and Ashutosh, one product that you would recommend to our investors who are the viewers today, which they would look at from your kitty. So, Satyan, what is your favorite product from the ICICI Pru kitty that you would recommend to the people who are watching the talk, that look at this product, it can add great value? What would that product be?
If I were to look at it in the current context of uncertainties around interest rates, uncertainties around the economic outcomes, uh, I would actually suggest that at this point of time, a guaranteed return product would be a best fit from a customer's point of view. And to that extent, we have a product in that space, which we call GIFT, that is very flexible, that is quite comprehensive in terms of the options it offers. And it also, most importantly, has an insurance cover that ensures that a person is able to reach their savings objective, irrespective of whether they are alive to contribute or not. So, contextually, I would think that is a good product for people to look at this point of time. Another point of time, the answer may be slightly different.
Yeah, so long term, I think Gift is an amazing product, and I hear from my team the kind of response it's getting in the market is also phenomenal. Can I now put that question to you, Ashutosh? Given the corrections in the market, what has been happening, so which is one of your product that you would recommend to the viewers today? Okay, look at this product; it may add a great value to your portfolio.
Sure, I think I'm quite clear in my mind. First of all, that everybody in the country, and irrespective of age, because I don't subscribe to the age mechanisms, should invest in equities. And we have a product called Mahindra Manulife Bharat Multicap Yojana. It is a multicap fund. It's an all-time high, a good performer. It's a very, very stable fund. And to give you an example, that it kind of returns it's generated over its lifetime are close to 20% CAGR in the SIP as well as in lump sums. This is the fund I advise to anybody who's looking to start to make an investment. And if you want to try it out, you should do an SIP. If you don't have a large lump sum to collect, but if you want to put in lump sums also, this is the product I would go with because it's stable. It invests equally in all kinds of capitalization norms, so it cuts across the markets. It's been there for a long time and it's outperformed its peers in all durations all the time, including if you spoke about the correction. As a house, we anticipated the correction well in advance, so we took defensive positions. This fund does extremely well even in the correcting markets. So by and large, I would say if I have to pick one product for my portfolio, this is the one that would suit everybody. There are other products that will suit different people, but this is the one I think suits everybody. It's called Mahindra Manulife Badhat Yojana.
Superb. So one is Mahindra Manulife's the multi-cap fund, which is called the Badhat Yojana, and then from Satyan, which is the gift plan from ICICI Prudential. So, guys, these are two concrete products or concrete actionables you have for you to evaluate. And let me thank you both, Ashutosh and Satyan, for an amazing conversation. This is our 25th, probably the most interesting one I have had because it's been very mentally stimulating for me. I know we are almost 20 minutes over time, but thank you for taking out time and joining us today. And I hope you enjoyed the conversation as much as I did. And thank you to all the viewers. We have a fantastic number of people who are watching it online. Thank you, guys, and some amazing, amazing questions. So I have to say the quality of people watching and the quality of questions coming in, I've not been able to take all, but I'll promise that the team will try to answer. But your views, comments are fantastic and phenomenal. Really amazing, guys. Thank you for joining and keep joining us. Some last words from you, Satyan and Ashutosh, before we close today.
Satyan, you want to go first?
I think you you actually set the context very well, Sanjeevji, when you started the conversation. Excuse me. You started the conversation very well, saying that people have to prepare themselves from a knowledge point of view as they move ahead. And the more you learn about the various dimensions of investing, personal finance, risk management, you will be able to add much more value both to yourself and to people around you. So I would very strongly echo that pitch that you made to start off with. And personally, from my side, thank you so much for having me here on the show today. It's been a privilege for me, and hopefully, I will have more opportunities to engage with your wider audience over a period of time on a variety of topics. Thank you so much, Sanjeev.
Thank you. Ashutosh?
Sanjeev, I think this initiative that you have is absolutely amazing. I don't know of anybody else who does this. And if this is the 25th edition, obviously you've been at it. I can imagine the quantum of preparation it takes to get something like this going. And so kudos to you and your team. It's an outstanding piece of work that you're doing and bringing so many investors and potential investors in touch with what are the concepts, what are the issues they should be grappling with. It's been very gratifying actually to participate on this show. I've been able to speak my mind. Typically on media interviews, you have to give the party line, but this is a place I've been very happy to speak my mind. So thank you for the opportunity, and I look forward to more such interactions with you and your team.
Thank you. Thank you, everyone, for joining us today. And we hope to keep continuing value to your life. And thank you for helping us make it a very unique product or unique concept that we are bringing to you. And I hope it's adding value to you. Thank you, everyone.
Thanks.